Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. All right, good afternoon, everyone. Thank you for joining in on my Tuesday session on real estate and taxes. Today, we're going to be talking about how to reduce your capital gains taxes in Canada. So today's agenda includes defining what capital gains taxes are, followed by 5 top strategies that you can use to reduce your capital gains taxes, followed by some of the final takeaways and tips. So what is capital gains tax? Well, let's assume you bought a home for $500,000, then you sold the home a few years later for $700,000. The difference between 700 and 500 is your gain. That is technically called capital gains tax. Now, once you have a capital gain, you need to pay taxes on it. Now, what are capital gains taxes? Well, it's basically the $200,000 gain will be 50% taxable to me because it was an investment, and I'm going to be paying taxes on the remaining $100,000 by adding it to my personal taxes for that year, and whatever income I have for that year, it'll get added on top of it. It's going to, whichever marginal tax bracket or tax slab I am in Canada, that's where I'm going to be paying taxes on. But today we want to go a little bit more in depth. So we're going to be talking about 5 strategies that can really help you bring down that capital gains tax. So first strategy that I want to talk about is selling assets gradually and using capital gains reserve. So let's assume in our example, when we bought a house for $500 and we sold it for $700,000, there was a $200,000 gain. We can either collect that gain in one shot and report it in our income. Why not break that $200,000 in 5 years and maybe collect only $40,000 each year, and can basically be used to reduce our overall taxes. So that is the strategy that you can use to reduce your taxes, and it is called capital gains reserve. And you can technically read a little bit more about it on the CRS website. Strategy number 2 is talking about RRSP contributions. Well, a lot of the time people don't max out their RRSP contribution for the year. The max limit right now is $31,000, but if let's assume you haven't ever contributed to RRSP, it keeps on growing and piling up. So my suggestion is, whenever you have a large capital gain in a year, you can max out the RRSP. Maxing out the RRSP will technically give you a tax benefit, a tax deduction on your personal taxes, and you will be able to recoup some of the taxes as part of the deductions. So if let's assume my gain was $200,000, I can technically contribute $31,000, provided I have the room, to the RRSP. By contributing $31,000 to RRSP, my tax liability will drop down by roughly $15,000, which is another great way to reduce your overall taxes. So now that we understand how capital gains are working, let's talk about number 3. Strategy number 3 involves creating a family trust. In a family trust, what you can do is you can have the property rolled over to a trust and be assigned to various family members. So let's assume if you have 4 family members, you had a capital gains of maybe $1 million. Each member can report $250,000 rather than one family member reporting $1 million, which is technically very high taxes. So that's the strategy with family trust. Right now in Canada, the first $250,000 of capital gains tax is taxed at 50%. But if you make more than $250,000 of capital gains tax, you'll be penalized with 66% tax rate. And this will basically keep you into the 50% tax bracket rather than pushing you into 66% taxes. So that's my strategy number 3. Strategy number 4 is talking about using capital losses. A lot of the times when the COVID happened, the stock market dropped, maybe your stocks were not performing well, so you ended up selling them. If you have a capital loss from selling stocks, you can actually use those losses and apply it against your capital gains. The good part is, even if the loss happened in the previous year, you can technically carry it forward and apply it against future taxable capital gains. So applying capital losses is another strategy to reduce your overall taxes. This strategy is also called tax loss harvesting. So let's assume if you have some property that has dropped below the value that what you had purchased for, you can sell it at a loss and use it in the future years to reduce your capital gains. Strategy number 5 is purchasing stocks individually. So what happens is, whenever you are in the market to buy stocks, you can technically buy it under personal name or you can buy it under corporation name. The Canadian government in June 2024 included that the tax rate for capital gains will be moving to 66% if you buy stocks under the corporation. So a simple suggestion is buy stocks individual, because under individual, first $250,000 is still taxed at 50%. Anything above $250,000 will be taxed at 66%. So buy stocks individually and reduce your capital gains tax. So my final takeaway and tips for today is, first of all, make installments. So if you had a capital gains in the current year, you already know you have to pay taxes. But if you wait till the end of the year, you're going to be paying penalties and interest on not paying installments. We already know in Canada also that whenever we buy a principal residence, there is no taxes. When we sell it, there's zero taxes. But a lot of people ask me, is there something available for businesses? Well, there is a solution. It's called lifetime capital gains exemption. So I'm an accountant. I've been running the business for roughly last 8 years. We have 2 offices. If I decide to retire today, I can sell that business, and the first $1.25 million in capital gain, that technically is not taxable to me. Speak to a qualified accountant before the sale of your business to make sure that you meet those conditions. So make sure you book a call with us or someone, one of your accountant, to better guide you. And with that, we'll wrap up today's presentation. Thank you for joining. We'll see you next week. Thank you.